Thinking of investing in Southern California real estate? Who could blame you? Los Angeles and Orange counties have some of the best real estate opportunities anywhere on earth. Let's face it, more generational wealth has been created by investing in California real estate than any other way. Now, when people typically think of real estate investments, they think of it as a good way to get a monthly income. However, in our major markets like Los Angeles and Orange County and anywhere around there, most of your wealth is created through appreciation. Now, we look at appreciation, you talk about not only appreciation in the value of the property, but over time, you have to remember, rents start going up, your loan balance goes down, and of course, the value of property as well. That's where the real money's made. At the Mike Dunfee Group, we strive to simplify the process. So here, I'm going to boil it down to the basics and give you 6 steps for successful investing in Southern California real estate. Step 1, determine your price range and property type. Even if you have unlimited financial resources, you still need to figure out how much you at least want to start investing with. And you'll need to know the property type because the loan requirements, assuming you're getting a loan, will vary depending on the property type. A single family residence is going to be different than a 1 to 4 unit. It's going to have different requirements than a 5 units and up, and it goes up from there. So you kind of got to know what kind of property you're looking for and how much down payment, how much equity you're looking to put in there, and if you're having any loan amount, how much you plan on borrowing. There's just too many options if you don't have that narrowed down. Step 2, choose who your market is. One of the nice things about the Southern California real estate market, whether you're in Long Beach, the South Bay, Orange County, Los Angeles proper, you have high-end, mid-range, and like more affordable type of housing. So you need to pick who your market is. Whether you say you have $10 million to invest, you could put that in luxury, or you could put it in affordable housing, or somewhere in the middle. Generally speaking, properties at the lower rent ranges will have better monthly returns, so higher cap rates, and the properties at the more higher end, if you will have lower cap rates or lower monthly returns, but will generally have a much higher expected appreciation rate. So you might want to factor that in when you're deciding which market or who is your market. Number 3, select appropriate neighborhoods. Once you know your price range and who your market is, then you can find a neighborhood appropriate for your strategy. So, as example, Palos Verdes and Naples, great places to invest in real estate. Probably not the best for affordable housing. Likewise, Wilmington and West Long Beach, another terrific place to invest in real estate. Probably not the best place for multi-million-dollar homes. So once you have that, you can find what fits for you. Little tip, finding neighborhoods that are transitioning for the better and participating in that is a great way to make an extra return on your investment. Step 4, determine if you're more of a turnkey investor or a value-add investor. So what may be the deal of a lifetime for one person may be a huge mistake for the next. So most investors I would put in the category of turnkey. That means they're looking for properties that are rent ready, perhaps already have tenants in them, and there's not a whole lot more they have to do than evaluate the decision, make it, and then maybe be so lightly involved from then on out. And that's great. You can also be more of a value-add investor, someone looking to add value to the investment besides just buying it. Some examples of this include renovations, which may include everything from simple paint jobs to installing new kitchens and bathrooms and changing out plumbing. This could be for one unit or an entire complex. Or adding square footage. You may look at taking a 2-bedroom, 1-bath, 900 square foot house and turn it into a 3-bedroom, 2-bath, 1,700 square house. Adding extra units. This is becoming very popular with this new trend in accessory dwelling units, commonly called ADUs. Or you could even change the property type from a commercial to a residential. This is known as adaptive reuse. Now, knowing your capital, your expertise, and your time limitations are key in determining if you are ready to be a value-add investor. Step 5, know the numbers. Before you move forward with any real estate investment, you want to make sure you know and understand the numbers. And you want to be realistic in this. You see, in Southern California market, places like Los Angeles, Orange County, Long Beach, the South Bay, any of those areas, you're going to need a significant down payment before any of these properties cash flow. So you're really going to understand what your expenses are. As example, your mortgage, property tax, insurance, any capital improvements, maintenance expenses, HOA fees if they apply, property management, and any other operating costs, plus contingencies like vacancy allowances. And in this market, you don't just stop with your monthly cash flow. You also want to take in consideration expected appreciation, improvement in rents, principal reduction, plus all the tax advantages before making your final decision. When trying to figure the potential of a real estate investment, you want to take in consideration your own financial goals and see how that lines up with what the actual numbers are. In this market, the real money's made in the long run, not overnight. Step 6, consider professional property management. Look, in Los Angeles and Orange counties and any sort of neighborhood around here, the laws are extremely tenant friendly. In fact, you could say that about all of California. And the laws keep changing and they pretty much are always going more and more tenant friendly. That's fine, you just need to understand it. Besides that, also tenant expectations keep increasing. They expect to pay rent online, make their maintenance requests online. They expect quick turnarounds. It's just a higher level of service is expected by the tenants as well. This is causing a lot of real estate investors to opt for professional property management. Look, the smaller investor they're generally not up to speed with everything. There's just too much to know. And your larger investors, those who have more properties, are more likely to know more of the rules and be up on more of the changes, but then you look into the logistics of actually performing all of that. Having that professional property manager takes a lot of that pressure off of having those investments and lets those investments really work for you instead of you working for them. In a nutshell, investing in Southern California real estate can be tricky. However, it may be one of the most lucrative things you'll ever do. Hopefully, these 6 steps were helpful. If you'd like more guidance on investing in Southern California real estate, or would like some help with your property management, please feel free to reach out to the Mike Dunfee Group. We'd be happy to help.